All right, so we finished the week on a sour note here. The question is, how sour of a note was it? Is it sour? I mean, has the pullback started? Is this the selling? Are we going to have more selling next week? Is it really going to, accelerate to the downside? I'm going to break all that down based on what these charts and indicators are telling us. Or what should we expect to see next week? Are we going to get a bounce? Are we going to break through the new lows? If we do get a bounce, was this enough of a pullback to start a new multi-month leg higher? I'm going to break all that down and show you what my expectations are. Then we're going to talk about a trade that would take advantage of what my expectations will be going into October expiration. So let's go ahead and get started. Today is Friday, September the 18th, 2020. This is the Market Outlook from MarketScholars.com. My name is David Settle. All right, as we take a look at the market forecast indicator on the S&P 500, you see that we have a few different, a little bit of a red flag that popped up here with the dark pink shading and a red line finally. It's only one day, but we finally got that combination here today. And as of right now, on Monday, will be a red line too, depending upon, again, the only really way to change it would be to have a really bullish day on Monday and get back above that line, which is right now about, what is it at, 3406.50. So that's where we'd have to close, and that's nearly 100 points up to the upside. So not impossible, but a little unlikely, considering the up days don't tend to be as big as the down days here lately, especially with a falling market sentiment line that most likely will fall below the 80th percentile and reflect a weak bearish posture there. The nice thing is, though, it's kind of like you'll see a recurring theme here of these red flags on some charts that are combined with not so red flags on the same chart. And the same thing here is we're not below the 23% retracement level yet. So, again, if this is as bearish as we get without even getting a 23% retracement, that's great, right? That's exactly what we want to see. We were really close to an oversold cluster, especially on the NASDAQ. We ended up not getting one, but at the lows of the day today, you can see how much we came off the lows. At the lows of the day today, we were very close to a cluster. I ended up not getting one, even more so on the S&P. So, the short-term sentiment is not as bearish, right? We didn't finish in the reversal zone. The momentum line did not finish in the extreme lows like we were sitting at when we were at the lows, especially on the NASDAQ. And if you look at the Russell, we're in fact that much closer to actually a dark green shading. With the intermediate line rising, it looks like it will continue to rise up above 50. So, when you look at the NASDAQ, which is flirting with breaking the 23%, it actually is below the 23%. Then you look at the Russell, so this is where the NASDAQ is here compared to the Russell. You can see the Russell is really holding up very well. Now it hasn't rallied as much, but during this pullback that we're getting here, this little decline, this little noisy decline that we've been getting, it's been mostly the NASDAQ. And, not surprising because the NASDAQ's got more room to fall. It's got its margin of safety is worse. You see it's also got the dark pink shading. It's 2 days now, dark pink shading and red line. So we'll see if there is any kind of bounce back up here post-September expiration. The Dow Jones Industrial Average has light pink shading and a yellow line, which is a bullish combination, especially with the potential for a bullish near-term high to develop, coming off of what would be a bearish near-term high. So we're kind of at that point, and we talked a lot about this really in detail in our technical analysis class about two possible scenarios of how we could open up on Monday. Being Sunday night, one of the scenarios was that we would start to really gap down, that some catalyst would occur, that would really break down hard towards the 23% there, through the 23% of the S&P, and potentially have a really down day Monday. And of course, that could still be the case. We did gap down a little bit at the open on the futures, but rally to fill in that gap, and are actually up a little bit on the futures as we speak on the S&P. So we'll see how that plays out. But so far, so good in terms of not getting, a steep decline, which again makes it likely that we can bounce, barring a catalyst that could really steepen the selling. Most likely bounce off of this kind of oversold short-term condition that we have right now in a lot of these indexes, and potentially allow the Russell to continue to play catch up itself. Because I think the Russell similar to what happened over here during June that culminated in early June. The Russell and the Dow, for that matter, needed to play catch up before we finally had that little decline, noisy decline. I think we're still catch up away from these indexes kind of catching up and showing some bullishness before we get a broader intermediate decline where we actually do get light pink shade or dark pink shading and red line for a longer period of time, an actual intermediate decline, which I don't think this is quite yet. Alright, before I show you some other charts, I invite you to subscribe to our YouTube channel. Mouse over this icon right here in the bottom right corner of your screen. Hit the red subscribe button that pops out. There's also one down below the video if you're watching us on YouTube. Also, while you're down there, hit that thumbs up icon. That tells us two things. You liked our video today and you want us to do another one on Monday. It's a quick way to give us feedback. If you like our videos and you want to let us know, you can do so with one click right now while you're watching. If you don't like our videos, of course, you don't have to click on anything. And as always, you don't even have to watch. Right. Also, while you're down there, comment on our video. What did you get out of our video today? What stood out to you? What questions or comments do you have? Post those in the comment section down there. Join our website at marketscholars.com. There's a link popping out right there in the top right corner of your screen. Click on that link to subscribe to our site for free. Follow me on Twitter for more content in between the videos from day to day. There's my handle right there at DavidSettle42. And join our Market Outlook Facebook group that we've created. If you're watching our video here on our blog, check these classes and videos out here on the right-hand column. This one right here, if you click on that play button, that takes you to our Market Outlook live video. Every day I do the Market Outlook, I do a live video that day at 3:30 Eastern Time. I review all the existing old Market Outlook trade ideas I've done. The ones that we haven't closed out yet. I close out any that we need to. I manage the trades. I teach you how to continue to manage the trades from the time you get into them. So it's a little different than other videos where people just give you trade ideas here and there and everywhere. When I give you a trade idea, we actually continue to trade the idea all the way to the time where we close the trade. That's what we do in this video here. So in the Market Outlooks, I give you the trade idea. Market Outlook Live, we continue to trade all the way to the close. We also put on today's trade idea before the market closes. So we got into this trade already Friday before close. So if you're watching this during the weekend, of course, then that's a little bit of a preview. You get a little bit of a preview if you get access to that. Again, all of our subscribers, our Plus and our Premium, so our monthly subscribers, which are our Plus subscribers, and then our Premium subscribers get access to that video. And then our classes over here on the right. We also invite you to hit this heart right there. It opens up a new window. Hit that like button. Also hit the thumbs up. Opens up another new tab. Takes you to your Facebook page. And leads to our Market Outlook Facebook post. We invite you to hit that like button right there. Again, the more you do that, you can see this post only got to 146 people. I have over nearly 1,500 followers, but only 146 people saw this post. So the more you like it on Facebook and Twitter, the more our post will get to all of our followers, so that they can see that. Again, it also benefits you too, because Twitter and Facebook will promote content in your timelines from the accounts that you engage with the most. We try to make it really easy for you to engage with us here. All right, let's get back to the charts and let's take a look at how the weekly chart ended up. And again, when you're looking at bearish candles, you're looking to follow up a bearish candle. Usually they follow up bearish candles with really bearish, with more bearish candles. You try to get a lower low, which we did at the very end of the week, mind you. But we did get a lower low. We got a lower close, just barely, but we got a lower close. And then again, you want to follow that up without a upper shadow. And we didn't really get that. And the other thing too about, really big, and when you get these bearish intermediate pullbacks, is the bodies end up being pretty big. And that wasn't the case here. That's not necessarily the biggest body. So again, another sign that this might be really all there is right now. There might be an opportunity for us eventually to get more of a pullback past the 23% retracement. But as of right now, we might get a little short-term pop after this expiration in the next week and a half maybe, before, like I said, the real intermediate pullback begins. If we take a look at the 3 green arrow chart, whoops, not that one. This one, you can see again we have 3 red arrows and again a red line being below a falling moving average, so and a little bit of a pickup in volume as well. So there's again, red flag, we are below. We haven't been able to really bounce back above the 17-day moving average here. We've been below the 17-day moving average all the way since here. The only time we got close was right there, and we actually closed down by the end of the day, and the MACD histogram's rolling back down too. The stochastics is above its moving average still, even if the MACD isn't. And the MACD histogram, while it is rolling down, potentially is forming a little bit of a divergence here. When you look at, again, the RSI and the CCI, you look for a breakdown below 40, which we don't have yet. You look for a breakdown below negative 200, which we don't have yet either. Again, you look at the DMI and the ADX, and you can see, okay, that actually is a little bit of a bearish pattern, which, again, is another one of those signs that, Monday, like, again, most of the damage from a bearish move occurs early, right off the bat. And so we spike up, which means either Monday or Tuesday, there's a very good chance for us to spike up really quickly here. That's why I say this is either a little bit of a fake out against some red flags and not so red flags, or here we go. And Monday, Tuesday at the latest would be would it be our breakdown that we're going to get hard. But again, barring a catalyst, that we need to actually produce that. If you look at the Ichimoku cloud, we're still above the cloud. So while we are below the blue line and both lines are falling, and we're still actually below the Tenkan line as well, the green line, and the red line did cross below price, which is also bearish. These are all bearish signs, but we're still above the cloud. So again, not a red flag. And you can see while we have a bearish trend here developing, it's very weak. So, is this again a little bit of a sign that's like we're not quite there yet, and a little bit of a fake out breakdown to the downside, especially when you consider, where we're at right now. There's a lot of volume here. It's going to be really hard for us to break down sharply in one big fell swoop all the way down to the point of control. And like I said, that's probably all we get down to. We might not even get to the 38%. We might stop right around that 78% line because there's so much volume between where we're at now and down there. So again, another sign that we might not really break down hard here. That we might bounce up. This process of an intermediate pullback will be more of a longer process that will include some moves to the upside before we finally get down eventually to our lowest point on the downside. All right, now let's take a look at the intraday chart here. And you can see, there's the close and there's the move off the low. So we broke down to a new lower low. Interesting, on SPY we broke down to a new lower low, but not on the equal weighted index for the S&P. So again, it kind of shows that this is mostly a QQQ issue, and you can see how it broke below that low. Diamonds got to its low point of the week of this past week, but didn't go through. And of course, IWM well above that low point. So again, very, very dominated. Very, this selling has been very limited to a specific area in the market, and it's not following up, especially not following up too. With a sharp move higher in the VIX. You can see the VIX actually is at this bullish sweet spot, which is another sign that this might be really much ado about nothing. And the other factor too, during the selling that we had here over the past couple of days, especially when you look at like the futures contract, which trades overnight, you can see really from right at the close or right before the close on Wednesday, overnight into Thursday, you can kind of see how the futures performed. But if you look at like the Euro US dollar as a comparison to that, because again the Euro US dollar, the dollar will move kind of opposite. The dollar rallies when risk appetite wanes, the dollar will rally. And you can see as this pair fell, as the futures were falling, this pair was falling, which makes sense. The dollar rises when the futures fall. But you can see here that eventually the futures came down right about in this spot right here. You can see came to a lower low point right there, right around the European market open. But the Euro US dollar did not go down to a lower low point too. It actually stayed up and then it really rallied. And you can see by the end of the day it was way up here. It was actually close to these highs. So kind of for the futures, it would have been kind of in this spot, right where this point of control would be, 3,400, but we're 80 points below. So So again, I think this is a really more exploration related, because we're not seeing the same declines. You can see again when we went to a lower low, we didn't on the euro, and then we went to an even lower low here late Friday, and we didn't even get close to this low point on the euro. Didn't even come close to it. So again, it kind of shows you a very, very limited risk-off move, mainly limited to those mega cap tech names. Let's take a look at today's volume. I told you it was above average, 105 million, but the trading range a little bit above average itself. So when you look at the ATR, it's still underneath that 2% level. Breaking 2%, at least from where we're at, would be kind of the sign that here we go. And that's that's multiple 6-7 point moves like we got here. So we'll see if we follow up with another downside move of more than that. You can see on this chart here, it's a more than 1% decline, but we're not really getting the strong 2-3%. We had that 1-2% move here that only had a really small gap. The two big gaps didn't really finish with big moves. Maybe that one did, a little 2% there, but we're not following up with more bigger moves, which is what generally happens during intermediate declines, right? You generally follow up, these bearish moves here with bigger declines, and we're not getting bigger declines. We're actually getting smaller declines since we started out the early part of this month. You look at, again, the very, very beginning of September, that was our biggest decline, and we haven't followed it up with even bigger, like you do on some of these, where those intermediate moves really kind of pile up on themselves. Again, same thing on these last couple of intermediate pullbacks over here and here. Again, this pullback is kind of what I see happening from what happened in May of 2019. I see a very similar type of pullback occurring there. And if I were to show you here what happened in May of 2019, again, you can see we had kind of a big drop, and then that was really it. Then we had smaller drops as we eventually got to the 38%. Then we bounced off of that and we're really bullish. So very, very similar type of maneuver occurring here. You can see the VIX didn't really go up very much during that rally. It got up to 20%, but didn't really spike up. There was a big gap between the two. That gap shrunk, and then that was it. And it looks very similar to what we're seeing here right now as we speak. So I know we've grown accustomed to, when we go up every day for months, and when we go down, we fall off a cliff. That's not normal. That's been, kind of the market, this kind of market where where we feel like the Fed's got our back, so to speak, and when they don't, the market really tanks. That's not the normal, as we saw in May of 2019, that's not the normal way of pullbacks. We might be getting that type of pullback right now. And again, it's the process. Even in May, it didn't go down every single day. There was ups and downs, and that's what I expect to see here. We might be looking towards even a little mini upward move here over the next week, now that we're through expiration. This kind of week, this kind of bearish week that wasn't nearly as bearish as maybe it seemed when you look at all the different factors and indicators out there that reflect the price action or lack thereof that we had. Not nearly as bearish as it could have been, and again, while we may be at the beginning of an intermediate pullback now, don't expect it to be like what you've seen in the first quarter of 2018 or the fourth quarter of 2018 or this COVID pullback. Expect it to be more like the May 2019 pullback, which, a couple of years later now, or year plus later now, nobody even remembers that pullback. And that's kind of what I think by the end of next year especially, no one will really even remember this one, because it will be kind of this normal, steady, a little bit of a decline to eventually below 23 towards that 38%, bigger than normal because of how big the rally was. But then, by the time we rally afterwards, most likely post-election, once there is some certainty surrounding the outcome, then the markets will really kind of take off, and fueled by weakness in the dollar, you'll see here in a minute, and then no one will even think about. While we're kind of waiting for like another COVID-type decline, it's highly doubtful that type of decline will actually be produced. So what do you think? Do you agree with that? Do you disagree with that technical assessment? Let me know in the comment section down below, especially if you disagree. What are you seeing on whatever chart or indicator you're looking at that suggests whether you're a lot more bullish or a lot more bearish than I am? All right, now let's take a look at how these different asset classes performed over the past week. So I'm going to take this chart here and change the time frame to just show you this week that was. Let's go to 15 minutes on this chart here. There we go. And you can see how commodities had a really, really good week by the end of the week. Gold's somewhat bullish, more bullish early than late. You can see the dollar has been down for most of this week, and bonds have been down. So not really the most risk-off move for the week. Yes, the S&P was down, and you can see the Qs were down, but emerging markets were bullish. Small cap stocks were bullish. So again, not really the most risk-off week here as you would think that we would have. Again, that U.S. dollar, especially when you look at it from a Euro-U.S. dollar perspective here, you can see we're back to having dark green. I mean, we never really got dark pink shading in a red line. We're back to having a green line, and we're above the moving average. And we'll see how long this little near-term run lasts to see if it produces a new kind of leg higher on this, even again without its own pullback, so to speak, without getting down below the 23%, not producing dark pink shading and a red line. Of course, the intermediate line is well below the market sentiment, just like it is in the S&P. So there's room for it to run if and when we do get more of a decline. You can see the near-term lines just on the weekly chart has pulled back down and is bouncing back up, back above 50, and you can see opportunity for short-term sentiment to the upside here going forward into a new week. Again, that would be bullish for risk appetite, and that bearish dollar is what I think will fuel the long-term bullish move in U.S. stocks going into, like I said, next year and potentially even to the end of next year and the beginning of 2022. Let's take a look at yields. As I mentioned, the other thing too was that bonds didn't really go up, and you can see yields, their weekly chart themselves. They've had a really good run here, and they had a good week this week, and we're still below the moving average, so it's still light green shading. It's not even a yellow line yet. We kind of need to burst through that. Probably need to get above 75 basis points to really feel good about any kind of bullish move going up. If I look at the Bollinger Bands on the ETF, TLT, I mean, if and when we break down here, there's going to be a pretty sharp move. In other words, a pretty big jump in yields, which will reflect, rising inflation expectations, especially in the long term with the TNX. So that, again, that's not a sign of a bear market. They have, the TLT still up so very high, and when you look at it on a 5-year basis, I mean, look at that. I mean, the point of control in the 5-year chart's way down here. The value area is way down at 140. I mean, that's how it can fall. And you can see even we're at the 23% retracement of this rally. Like, we can fall down to and through the Fibonacci retracement zone all the way to the bottom of it, down to 138, just like that. And again, a lot of people think, and I brought this up as well in my classes this week, a lot of people think, well, with interest rates at 0%, the Fed's got interest rates at 0%, there's no way that the yield's going to stay down this low. Well, if you remember back in 2009, the interest rates were cut to 0%. We had QE. We had QE3 all throughout 2013, and the 10-year note, while the overnight rate was at 0 and we had the steady purchases of QE, we got all the way up to 3%. So we're less than 70 basis points here. We can make a run up to 1.75%, 1.5%, just like that, without skipping a beat. We don't have to stay down here just because of the Fed's policies. The Fed's had very similar policies over here, and we weren't this low before. In fact, those were, this move right here on yields is QE1. This run on yields right there is QE2. This run on yields is Operation Twist into QE3. And then, of course, this run on yields was coming after, going into and after the election, all the way up until this bear market started. And this bear market, I think, that culminated with the COVID low point, and now is bottoming out. And I feel like this QE4 that we're getting right now will fuel the next leg higher on yields, just like we saw here, here, and here. Again, all of those with the overnight rate sitting at 0%. And now, especially with the Fed saying we're going to let inflation run more than 2%. So they're not going to raise rates anytime soon, which means there's a good chance that this can run up to 3% and beyond eventually before they would ever consider even raising interest rates. And you know what sector would benefit the most from that is the financial sector. And if we take a look at how the sectors performed here this week, let's just go over here to today and come down to September. And we'll go to the beginning of the week, go to a 15-minute chart. You can see there's that financial set, lagging behind the market and then outpacing the market by the end of the week. And again, most of the weakness, including staples even, was in the tech, communication services, and consumer discretionary. And look at the big winners: industrials, energy, materials, weak dollar sectors, all doing very well. Real estate, financials, healthcare, doing really well on the week, on a down week. So not the most risk off, right? If this was risk off, we would expect utilities up here, we'd expect staples up here, we'd expect real estate up here, and healthcare, and which actually did have a decent move. But those would be the sectors we'd expect to outperform, not so much. So, there's a little bit of a catch-up trade going, and I expect, again, before this real intermediate pullback really comes to fruition and completes itself, over the course of, I think, would expect to be about a month to 6 weeks of just being down, not going down, but being down in this intermediate pullback. By the time that happens, this catch-up trade will be done, and then these safety trades will start to outperform while the risk appetite trade pulls back a little bit more broadly than what we're seeing here, where it's very, very targeted in these sectors. All right, so for our trade idea of the day, I wanted to take a look at a stock that's been doing pretty well here, and that's Lowe's. Lowe's is in light pink shading, yellow line, a little bit of a pullback here. Short-term sentiment's oversold, so I expect a little bit of a bounce. But again, I don't expect very much of a bounce. You can see a little double top forming already as it is. I also don't expect a whole lot of weakness either. It's a very strong stock. It's had a very strong trend going, and there's some volume developing in this area up above the value area. You can see from a trend strength standpoint, it's had a very strong trend. It's in a noisy pattern. It is up above the cloud. The cloud itself, you can see by October expiration, will be up above these blue lines, which you'll see where these blue lines come from here in just a second. If you take a look at the RSI and the CCI, you see, okay, the pullback is not that big of a distance. In fact, it's not even really barely below 50. It's barely below 0. The DMI is not showing very much of a decline either, though its ADX is coming down, which means we're not getting that strong of a move anymore. So we expect this is the strong move. If we don't get a big strong bearish move, then we'll just kind of grind here, kind of like this, where you get a big strong bullish move. Not as strong, obviously, but then we just grind before we get a bearish move. And that's kind of what I expect, that we'll just kind of grind going forward into that October expiration. Of course, if that's the case, if we're going to grind going forward, then the type of trade I like to do on that is to sell a put spread and a call spread, which is an iron condor. So we'd sell the 150, buy the 145, sell the 170, buy the 175. That sets us up for this trade here, where there's my break evens. And when I set those to this chart, that's where the break evens are. So as you saw, the break evens are above the value area. They're where this volume is picking up. I expect more of a volume node to pick up in that area as well. A lot of this volume will come off by the time we get to October expiration. As you can see, this volume node in this area right here will all come off. So the value area itself will actually start to ramp up and include some more volume up here as we lose some volume down there. So I think that by the time we get here, there'll be some pretty decent support and volume built up here. As we, again, potentially grind our way towards October expiration through some ups and some downs. And then that condor will be able to take advantage of that. All right, so that does it for today. As always, you've heard from me. Now I want to hear from you. Use that link popping out in the top right corner of your screen. That takes you to our Market Outlook forums on our website. All of our subscribers, even our free subscribers, get access to those forums. Let's keep this conversation going here. Open up any new threads. Reply to anybody else's threads. and let me know what you're thinking there. As always, thank you very much for watching. Remember to subscribe to our YouTube channel, hit that thumbs up icon, as well as on Twitter and Facebook too, and then comment on our video down below. Follow me on Twitter for more content between videos. Join our website at Market Scholars, as well as our Market Outlook Facebook group. Have a great rest of your weekend, everybody, and we'll see you all on Monday.